Tony Breen of Apostle Funds Management, thanks very much for presenting at the Investment Leaders Forum Byron Bay 2024.
Thank you very much.
Tony, what role do you see sub-investment grade credit playing in a portfolio given the rapid resetting of rates over the past 18 months?
Sub-investment grade credit gives you the scope to earn high yields. A lot of it is floating rate and a lot of it is very secured. So you're getting a yield enhancement, you're getting base rates have lifted and you're getting a yield enhancement from the credit spread above that. And that's giving you a range of protections because first of all, you haven't got a duration problem and you're also getting high levels of income. And especially for retirees that are looking for income when other sectors aren't providing it, sub-investment grade is able to do that very adequately. So when rate resets happen, it actually it benefits greatly the floating rate nature of a lot of sub-investment grade debt. Other sub-investment grade debt, I beg your pardon, is bonds, which does have a duration. Obviously there you're taking a risk on that, but they also have a place in the portfolio, but I'd suggest a lot of people have reduced their holdings in that so that the income effects become paramount.
Given the recent volatility in markets, what key factors do you consider to ensure stability and avoid defaults in the portfolio?
Avoiding defaults and any instability at all is going to hit sub-investment grade faster than most other sectors. It's the riskiest part of the fixed income chain. So there's two very important things to do when you're investing in sub-investment grade. The first is avoid the default to start with. So if you're not there, you can't get hurt. Secondly, if you are there and do get hurt, you've got to be able to work your way through it so that you get back as much money as you possibly can. Credit is a very simple game. It's lending and receiving. The simple part is lending, the hardest part is receiving. So you've got to make sure that you've got all the asset or the factors in place so that should you run into a problem with a debt, you can get back as much or all of the money that you're expecting.
Many local investors have exposure to the domestic real estate market. What does that mean for clients and their likelihood to experience concentration risk?
Enormous. The problem with Australia is that it's a very concentrated market. If you're invested in a REIT, you're probably also invested in the Commonwealth Bank. You're probably also invested in some private debt, private loans. And it could well all be based on property. So if something were to go wrong with the REIT, that means that Commonwealth Bank's price could be impacted and that the loan could be impacted. So the golden rule of asset management is diversification. You've got to look at your covariance or correlations of risks whenever you're investing. And in Australia, because a lot of debt is based on property as its security, it's very, very critical that you look through exactly all your assets or your investments and make sure you're not doubling up or tripling up on your risk.
Investing in this asset class has its own risks. For clients that want to reduce risk wherever they can, what guidance can an advisor offer in stacking the odds in the client's favour?
Plenty. Sub-investment grade debt isn't homogeneous by any stretch of the imagination, right? There's very low grade risk and very high grade risk. Senior secured loans are the top of the capital structure. So you can be investing in companies which are reasonably lowly rated, but giving you huge amounts of security, and the security is quite good. So the ways you stack the odds in your favour is, as I mentioned previously, avoid defaults, get back as much money as you can, and diversify your risk as much as possible. And as just previously mentioned, going up in the capital structure does provide a lot more support.
In the current economic environment, how do you adjust your strategies in sub-investment grade credit to align with market conditions and investor expectations?
Okay. Well, sub-investment grade credit at the moment is quite expensive. So realistically, the best way to do it is to avoid as much as possible. You don't want to ever be overpaying for an asset because inevitably that'll end in tears. If you are looking for income and you are capable of taking some volatility, The idea is just to de-risk as much as possible and go towards the higher tier credits. So senior secured debt of sub-investment grade still offers very high levels of security. And as I said before, avoid the risk as much as possible. And if you do happen to have a risk, make sure you can get back as much as you can.